Hello friends, welcome back to Newton's Club. I hope you all are doing great today. This is the part 2 of our finance and account series. In part 1, we explored the fundamentals of finance and accounts. We talked about revenue, profit, ROI, capital and many more using a real life example of Arun Agros. Today, we are taking it one step further. We are going to break down two important concepts in finance and accounts. Number 1, the accounting equation, and number 2, the three key financial statements. And as always, we'll keep it simple with a real life business example. So let's dive right in. The accounting equation, the backbone of finance. Think of it as a rule book of accounting. It makes sure that the company's financial records are always balanced. The equation is really simple. Assets equal to liabilities plus owner's equity. But what do these terms mean? Assets, what the business owns, like cash, equipment, inventory, or etc. Liabilities, what the business owes, like loans or creditors. And owner's equity, what's left over for the owner after paying off liabilities. So to understand this equation better, let's go back to our Arun Agros example. Now Arun is super excited. He's starting his own first business, Arun Agros. He invests 50,000 of his own money to get started. Now, if we apply accounting equation over here, assets of Arun Agros would be 50,000 rupees, the cash Arun has invested. Liability is 0 because he didn't take any loans. And so the owner's equity will be 50,000. So the equation is balanced. Now, after a few weeks, Arun realizes that he needs more cash to buy a refrigerator for storing fruits. So he takes a loan of 20,000 rupees from the bank. If we update our equation now, total assets will be 50,000 initial investment plus 20,000, the cash he got from the bank, which will be 70,000. And liabilities, 20,000, because he has to repay back 20,000 to the bank. And owner's equity will be same, 50,000 rupees. Again, the equation remains balanced. Now, business is booming. Customers love Arun's fruits. But one day, there is a shortage of inventory. Arun needs more fruits to keep up the demand. So he buys 30,000 worth of oranges from the market. Now, what happens to the accounting equation? The company spends 30,000, right? Which means the cash decreases. But at the same time, the company now has 30,000 worth of inventory, which means the inventory increases. So total assets would be cash component, initial 70,000 minus 30,000 rupees, which is 40,000. And now since he got an additional inventory, which is a worth of 30,000 rupees. So total assets are 40,000 plus 30,000, 70,000 rupees. Liabilities would remain same, 20,000, and owner's equity would remain same as 50,000. And guess what? The equation is still balanced. This is the accounting equation in action. A golden rule that keeps all your transactions organized and balanced. But here comes the next big question. How do companies actually record all these transactions? How do you know if a business is profitable, has enough cash, or is it growing over time? The answer lies in three key financial statements. Number 1, income statement, also called as profit and loss statement. This statement tells you how much money your business earned and spent over a specific period, like a month, a quarter, or a year. Think of it as a report card that shows your sales, expenses, and profit or loss. The structure is very simple. Revenue minus expenses is equal to net profit or loss. Example, suppose in the month of April, revenue from fruit sales is equal to 60,000 rupees. Expenses like purchase of fruits, rent, salaries, etc. is equal to 45,000 rupees. And the net profit is equal to 60,000 minus 45,000, 15,000 rupees. So Arun Agros made a profit of 15,000 rupees that month. Now going to the second statement, balance sheet. This statement tells your financial position for your business at any specific point in time. It's based on the accounting equation. Assets is equal to liabilities plus owner's equity. For example, let's say on April 30th, cash component of Arun Agros is equal to 40,000 rupees. Inventory is equal to 30,000 rupees. And there is a loan of 20,000 rupees and Arun's equity is 50,000 rupees. So total assets 40,000 plus 30,000, 70,000 rupees. Liabilities, there is a loan of 20,000 rupees. And finally, the owner's equity 50,000 rupees. The balance sheet is balanced. Now going to the third statement, cash flow statement. This statement tracks the movement of actual cash in and out of the business. This statement simply answers, do I have enough cash to run my business daily? Simple. And here the structure would be cash from operating activities like sales or purchases, plus cash from investment activities, buying or selling equipment, plus cash from financial activities, loans or owner's capital, is equal to net cash flow. For an example, if the cash received from selling fruits is 60,000 rupees and cash spent on buying fruits is 30,000 rupees and loan received from bank is 20,000 rupees, net cash flow would be 60,000 minus 30,000 plus 20,000, that equal to 50,000 rupees. So Arun's cash increased by 50,000 rupees that particular month. So we have explained these financial statements in the simplest form to give you a strong foundation. But in reality, analyzing and understanding financial reports can be much more complex. Let me show you what real financial statements often look like. For example, the income statement always begins with net revenue or sales. That's your top line. It ends with net profit or loss, the bottom line. And in between, you'll find multiple expense categories like cost of goods sold, employee costs, depreciation, and many more. It may look overwhelming, but the structure remains the same. Now, putting it all together, these three statements give a complete picture of your business. How much profit you made, income statement. What your business owns and owes, balance sheet. How cash moves in and out, cash flow statement. So friends, remember, this is the language of business. Even if you're not an accountant, understanding these financial statements will make you a sharper and smarter professional, whether you're working in production, marketing, HR, or any other department. So let's wrap up here for today. And in the next video, we'll start exploring a brand new department of manufacturing industry, one step at a time. Thank you so much for watching. Have a great day and keep learning with Newton's Club. Thank you.